Hello everyone, this is Tom Fox and I would like to welcome you to episode 27 of the FCPA Compliance and Ethics Report. Today is December 3rd and last week we had the announcement of the Weatherford Limited FCPA settlement. This has been one of the longest running FCPA investigations, been going on since at least 2008, and certainly in the energy industry something that was quite closely watched. The total amount of fines and penalties assessed against Weatherford, which they agreed to, was $252 million. However, $100 million of that was for violations of the old Iraqi oil for food program. I'm not going to discuss that in any detail here today because I'm going to focus on the FCPA portion of the fine and penalty, which was $152 million plus, which puts it at number 9 on the top 10 list as reported by the FCPA blog. Nevertheless, the Iraqi oil for food program is significant for a couple of reasons. First of all, the company did indeed engage in bribery and corruption in the oil for food program. The second is the FCPA professor today in a blog post opined that this may be the last oil for food case because this was during the prior regime in Iraq before the United States invasion, when Saddam Hussein was under extreme sanctions, but the UN allowed certain humanitarian goods to be shipped into the country, which the Iraqi government used as a means to obtain money through bribery and corruption. The third thing that is significant about this is many people believe that the oil for food program was one of the things that led to the increase in the enforcement of the Foreign Corrupt Practices Act. This came about because of a couple of things. First of all, after 9/11, the Bush administration was looking for current on-the-books U.S. laws which may help them in the fight against terrorism. I think it was recognized that porous borders due to bribery and corruption are certainly something that can lead to terrorists coming across the borders, getting into countries, and stopping that type of activity was something the Bush administration desperately wanted to do after 9/11. But the oil for food program was interesting because it gave a moral component to the fight against bribery and corruption. Certainly there were FCPA prosecutions before 9/11, and certainly before the explosion of FCPA prosecutions in 2004. Nevertheless, with the dramatic increase, many people have wondered what led to this increase. And I have to credit Dan Chapman, the Chief Compliance Officer at Parker Drilling, for this observation that it was really the oil for food program and U.S. companies following or acceding to the bribery or extortion request of the Saddam Hussein regime that provided the moral authority for the Department of Justice to start prosecuting general or other bribery and corruption more generally, utilizing the Foreign Corrupt Practices Act as a broader law than simply the violating the oil for food or the Iraqi humanitarian trade sanctions that were allowed at that time frame. I don't know if that's true. I haven't ever spoken to any Department of Justice officials, but certainly Dan makes a very persuasive argument, and if you ever have the opportunity, I would encourage you to ask him about that. But he really ties the increase in FCPA enforcement to the oil for food program and the violations of various U.S. companies. So certainly something to think about. But let me get to the Weatherford FCPA resolution. As I indicated, it was $152 million. $87 million of that was to the Department of Justice, and the remainder to the Securities and Exchange Commission in fines, penalties, and profit disgorgement. The conduct that Weatherford engaged in was truly pretty breathtaking in its scope. They had a certainly, if not a worldwide bribery scheme, one that was utilized in all of the usual places, with the addition of the country of Albania, which is not generally targeted for FCPA prosecutions because there's not too much U.S. work there or U.S. companies work, but Weatherford engaged in bribery and corruption of tax officials in Albania as part of their bribery scheme. I should mention that Weatherford is not currently domiciled in the United States. Nevertheless, most of their work is out of Houston, and I think they're generally recognized as one of the leading oil field service providers in the world, headquartered here in Houston. So even though they're, I think, domiciled in Switzerland right now for tax reasons. So with that, let's go to the Bribery Box Score, which, if you've seen my blog, I love to give the box score. And here we had different bribery schemes detailed. In Angola, payments through third parties of $250,000 to a Senegal drilling manager, joint venture partners consisting of government officials in Angola and family members of $810,000. In the Congo, we had reported payments of over $500,000 to state-owned enterprise employees and officials. In unnamed Middle Eastern countries, we had payments of over $11 million through distributors. I find it very interesting that these unnamed countries were indeed not named, and I've already been contacted based upon my blogs on which were these unnamed companies, and unfortunately I don't know the names of them. Nevertheless, certain countries in the Middle East, the company used a bribery scheme that we'll go into a little more detail, where they paid over $11 million in bribes. In Algeria, the company engaged in widespread improper travel and entertainment for state-owned enterprise officials, the Algerian National Oil Company. And in Albania, here we had $41,000 in bribes paid to tax auditors so that Weatherford's Italian subsidiary could get a clean bill of tax health there. So what were some of the bribery schemes? Well, let's go into those in a little more detail, because I think it's important for you to understand the types of bribery schemes that are used, and it gives you, as the compliance practitioner, a way to measure against what your company may be doing. As I mentioned, in Angola, there were two bribery schemes. The first one was through a traditional intermediary setup, which was a Swiss intermediary. This intermediary would create fake invoices and send them to the company. The company would pay these fake invoices, and then the money would be remitted into Swiss bank accounts or other places where the Senegal drilling manager in question wanted to have the money delivered. Of course, the intermediary took a cut, but there was a formal contract between the intermediary. It was approved by the Weatherford Legal Department. In fact, it was drafted by the Weatherford Legal Department, so you had pretty close direct company involvement in this. The second bribery scheme in Angola involved setting up of joint ventures. Now, it appears that Weatherford was directed to hire certain joint ventures as local partners. Always a red flag when that pops up. But then when the ownership structure of these two joint ventures was looked at, it was determined that one joint venture partner had as a member a governmental official in Angola, and also had his wife and other family members as part of that joint venture. The second joint venture partner was a official of Senegal, the state-owned enterprise. It's not clear if they were a governmental official, but in Angola, as in many West African countries, employees will move between the government and state-owned enterprises with relative ease, so possibly could have been a former governmental official. Nevertheless, a official of Senegal and family members of that person as well. So is pretty clearly that this mechanism was going to be used to funnel bribes to these persons who were decision makers in position to obtain or retain business for Senegal. Some of the activities that were detailed in the joint venture were pretty dramatic. For instance, a competitor of Weatherford secured a contract. Weatherford complained to their joint venture partners who were in the government. The government terminated the contract and kicked that other contractor out of the country. The government gave Weatherford an exclusive right to perform certain well service treatments, which they made considerable profit on. So it was pretty clear that the joint venture structure allowed Weatherford to engage in bribery and corruption in Angola. In Algeria, there was an interesting use of travel and entertainment. And so let me just detail some of these from the deferred prosecution agreement. In June 2006, two Sonatrach, that's the Algerian national energy company, were given trips to FIFA World Cup tournament in Germany. A honeymoon trip was given to the daughter of a Sonatrach official. Sonatrach officials were sent to Jeddah, Saudi Arabia, for religious reasons that were booked as donations. Additionally, Sonatrach officials were sent to the United States ostensibly for business purposes, but they received large cash payments which they could use as spending money. And when I say large, I'm talking about the tune of $24,000. So a nice per diem if you can get it. In Albania, a little bit unusual for a U.S. company to be caught in a bribery and corruption scheme in Albania. Nevertheless, instructive for the compliance practitioner going forward. And here, Weatherford's Italian subsidiary had a tax evaluation problem. It's not clear precisely what happened. The charging documents would seem to indicate that the Albanian tax authorities indicated that for 3 tax years, 2001, 2002, and 2004, they were willing to close out the tax audits and tax reports for certain payments. When I say it's not clear who made the initial extortion request or the request for payment, or if Weatherford volunteered this money, nevertheless, over $41,000 was paid to Albanian tax authorities, and the audits were closed out favorable to Weatherford, or at least their Italian subsidiary. So we have a pretty wide-ranging group of bribery schemes going forward in several different areas of the world. I would say they're all the usual suspect places. With the release of the 2013 Transparency International Corruption Perception Index, I think you will find that Angola, Middle East countries, the unnamed Middle East countries, I must note, Algeria and Albania are still perceived to be high incidences for corruption, so you still need to be careful in those places. But the schemes used by Weatherford were classic in not only the energy industry, but also in many other industries where these types of structures are put in place. So you have the direct payments, improper gifts and travel, use of an intermediary, a Swiss intermediary, no doubt, excuse me, and then the joint venture structure, which is a classic way to move money to governmental officials. And then you have outright payments in Albania. You don't often see those outright payments, but occasionally you do get the guys with carrying cash across the border, and that's what they had in Albania. So there were several deficiencies noted by the Department of Justice and SEC, and let me just read these as well. Failure to establish internal accounting controls to prevent bribery and corruption. Failure to perform due diligence on any prospective third parties, including the ultimate beneficial owners. Failure to perform due diligence in any meaningful joint venture partners, in any meaningful way on joint venture partners. Failure to have any meaningful internal controls for gifts, travel, and entertainment. No effective internal reporting mechanisms for FCPA issues. And up until 2008, and this is the most amazing, is they had no chief compliance officer. So given all of these very bad facts, and they are very bad, how did Weatherford come out of this as well as they did? I recognize $152 million is a lot of money, but remember Halliburton at $579 million sits up there, U.S. #1, and then the Halliburton joint venture partners from the joint venture involved in that bribery and corruption are all ahead of Weatherford. So what did Weatherford do to make a comeback? Well, the first thing they did was they brought a new sheriff into town, and they brought a fellow named Billy Jacobson. Billy Jacobson had been with the fraud section of the Department of Justice. He had gone into private practice, and after he had gone into private practice, he went to become the chief compliance officer at Weatherford. I think that it's significant that Weatherford recognized the problem they were in. They brought in someone who not only was a name recognized in this area, but also as a subject matter expert. And the clear message is, if you have a problem and you want to get serious, you need to hire a serious person. It doesn't have to be an ex-DOJer. It certainly doesn't have to be an ex-U.S. attorney from a specific locale. What you need is someone who can bring subject matter credibility to your compliance program. So if your company is in a FCPA pickle, you may need to hire someone who would bring credibility in the department's eyes to the remediation, because that's what Billy Jacobson instituted. The first thing he did was dramatically increase the size of the compliance function, from basically no compliance function to 38 individuals hired. I have heard numerous Weatherford compliance folks talk at conferences, and when they discuss their compliance program now, it is as best practice as it gets. They perform extensive due diligence. They even perform extensive due diligence in mergers and acquisition candidates who come in through the supply chain. That's pretty cutting edge, certainly for the energy industry, and I think for many others as well. Nevertheless, the increase in the compliance function, the dedication of personnel and resources is something that Billy Jacobson headed, and either the senior management of Weatherford or the Weatherford board certainly got the message. They truly increased their compliance function. I think they have one of the best-in-class compliance programs now. And let me just read from the Schedule C of the DPA the 17 things that they agreed to. 1, high-level commitment from company officials to do business in compliance with the FCPA, a substantive written anti-corruption compliance code of conduct, written policies and procedures to implement the code of conduct, a robust system of internal controls, risk assessments and risk reviews of ongoing businesses, no less than annual assessments of the compliance program, effective training for all employees and relevant third parties, an effective compliance program to provide guidance to company employees, a robust internal reporting system, appropriate incentives for employees to do business in compliance, appropriate discipline for those employees who do not do business in compliance with the code of conduct, a correct level of pre-acquisition due diligence on any third parties. When Weatherford acquires a company, they will, as soon as practicable, integrate the newly acquired entity into the Weatherford compliance program, and then ongoing monitoring, testing, and auditing of the company's compliance function, taking into account, and I think the significant relevant developments in the field and evolving international and industry standards. The last thing that I think is significant is that Weatherford has an external compliance monitor, but this external compliance monitor is not for the full term of the deferred prosecution agreement. The DPA itself is for a 3-year period of time, and the monitor is only for 18 months. It's interesting that Weatherford, in addition to some other companies, Total being the most prominent, but also Diebold Corporation, were required to have external monitors appointed by them in conjunction with their deferred prosecution agreements. In other words, this is something the Department of Justice wanted. But it's interesting that the department has cut the time period down from the full length of the deferred prosecution agreement to, in Weatherford's case, 1/2 of the deferred prosecution agreement. I guess the department is signaling that there's some comfort that the monitor will be able to determine whether the company is taking the implementation of the deferred prosecution agreement and the maintenance of its best practices compliance program going forward seriously. So very significant FCPA settlement. If you're interested in the oil for food at all, I would suggest that you read the documents. I've got sites to them on my blog site, which is the FCPA Compliance and Ethics blog found at tfoxlaw.wordpress.com. The FCPA professor also has full sites or links rather to all of the charging documents, so you can take a look at those. But lots of lessons to be learned from the FCPA component of this Weatherford settlement. First of all, a long, strange journey, a very long, strange journey for Weatherford. But once again, the message from the Department of Justice: if you engage in substantive remediation, you'll receive credit for that. One of the interesting things about the Weatherford conduct during this period is, number one, they did not self-disclose or self-report. The Weatherford action came out of the Panalpina investigation. The second thing is, and specifically noted in the deferred prosecution agreement and other charging documents, prior to 2008, when Billy Jacobson came on board, Weatherford had a very poor record of cooperation with the department in its investigation. They actually destroyed documents. They tried to hide witnesses. They tried to hide computers. things that the department frowns greatly upon in any criminal investigation. Nevertheless, so Weatherford were not necessarily penalized, but their score was not reduced by, the range of their fine was not reduced for these types of nefarious conduct. What's interesting about the range of fines is Weatherford got the very low end of the range of fines. It could have been $100 million higher. So obviously the remediation played a very big part. The thing I would like to leave you with for the Weatherford Deferred Prosecution Agreement and FCPA resolution is you can make a comeback. As Paul McNulty says many times, the most important question is what did you do when you found out about it? And at least after Billy Jacobson came on board, it's pretty clear that Weatherford took their obligations seriously and remediated seriously. If you'd like to take a look at these issues in any depth or further, please take a look at my blog. And if you have any questions, you can email me at tfox@tfoxlaw.com. Thanks for listening in, and looking forward to visiting with you for episode 28.